Have you done a Roth conversion earlier this year? For many, it can be a fantastic mood, especially if the market's up and down, a little bit volatile. But there's a hidden trap you need to know about. And if you don't handle it, it's a big deal. What I mean by that is if you don't handle the taxes correctly, you could end up facing unexpected penalties. But don't worry, I got a simple strategy that can help you avoid those unnecessary tax headaches. So let's break it down. All right, you ready? Here we go. So the IRS works on a pay-as-you-go system. And what that means is when you earn income, including from a Roth conversion, you are expected to pay the taxes on it at that time. So if you convert in January, the IRS expects you to pay your taxes within a reasonable time frame. Well, what's considered reasonable, right? The IRS follows a quarterly schedule. So a January conversion, taxes would be due in the first quarter. That would be by April 15th. Second quarter conversion, that would be due by June 15th, and so on and so on and so on for the whole year. But here's where it gets a little tricky. Not all tax payments are treated the same way. So let's talk about withholding versus estimated payments, because there's a big difference on here, all right? There are two ways that the IRS considers what's going on, or how you handle your taxes and how you pay your Roth conversion taxes. Number one, withholding. That means the taxes are taken directly from a distribution like an IRA withdrawal or a paycheck. And the other one is estimated tax payments. And those payments are manually sent to the IRS. And those are usually sent from your bank account, or possibly they would come from another interest-bearing account. And they're supposed to be paid as you go. But here's the key difference. Withholding is treated as if it's happened evenly throughout the whole year, no matter when you actually make it. But estimated tax payments, those have to follow the IRS strict quarterly deadlines. So let's say you convert about $100,000 early in this year, but you wait until December to pay your estimated taxes. If you do that, you are looking at penalties. But if you instead withhold taxes from an IRA withdrawal, the IRS considers it as if you've paid the taxes all along. And that is a major advantage. Now, many of our workshops for retirement clients know the best way to cover your Roth conversion taxes is from a taxable savings or investment account. But there's a catch. You can't withhold taxes from those accounts. Instead, here's what you do. You have to make estimated tax payments following the quarterly rules. So let me give you an example. If your conversion tax bill is $20,000, the IRS expects that you make 4 $5,000 payments, one per quarter, to stay penalty-free. But what if you pay all your taxes correctly and still get hit with a penalty? And here's the big issue. The IRS doesn't actually know when you performed a Roth conversion. So it's not listed on your tax forms. If you pay a large estimated tax payment late in the year, the IRS assumes that you owed the money earlier in the year, even though you may have done it exactly correct and you may have done your conversion late in the year. That's where your friend Form 2210 comes in, right? Who would ever thought I would call that your friend? But your Form 2210 comes in. And what that form allows, it allows you to show when the income actually happened, and then you prove that you followed the pay-as-you-go rule. So let's say you converted in December and paid the taxes then. This form helps prevent an unfair penalty. So Form 2210 will take care of that. But here's another scenario. Let's say you made a mistake. Maybe you converted early in the year, but you forgot to make the tax payments. Well, now it's December and you're staring down a pretty big penalty. What can you do about that? Well, here is an amazingly powerful IRA strategy. Instead of taking the money to pay your taxes from your savings accounts or investment accounts, take a distribution from your IRA in December and withhold enough to cover the taxes on the Roth IRA. Then, within 60 days, redeposit that same amount of money back into your IRA. Now that you do from your savings account or from your interest-bearing accounts. And using the 60-day rollover rule, that allows you to refund the IRA. Because you used a withholding, the IRS treats it as if you paid your taxes evenly all year long. And what that does, it helps you with wiping out all the penalties. As long as you replace the money into your IRA within 60 days, there's no long-term tax impact. And it's important to note that you're only allowed one 60-day rollover every 12 months. But if you ever find yourself in a tax jam, this could be your escape route. So here are the final thoughts on early year tax Roth conversions. Are they still a great strategy? Well, I think so. They can be. But don't let the tax rules scare you away from Roth conversions, especially if you're thinking about doing it early in the year. In fact, sometimes converting when the market is down is the best way to lock in some tax-free growth for your future. If you want to learn more about how to take advantage of discounted Roth conversions and how to keep more of your hard-earned money, connect with one of our expert advisors. Join us at one of our workshops for retirement workshops in your city. I'll put the links down in the comment below. If this information was helpful for you, if you'd like to learn more about us, be sure to like and subscribe to our channel so that we can keep you advised when we have new stuff coming up. Until I talk to you next time, this is Dennis for Workshops for Retirement saying stay well and in retirement, stay wealthy.